Good afternoon. This webinar offers closed captioning. To enable closed captioning, click on the live transcript button on the bottom of your screen and choose your preferred method. Welcome to the City of Chicago Department of Business Affairs and Consumer Protection webinar. Please note any website or email that I mentioned will be posted in the chat box. For those seeking business licensing assistance, you can visit the Small Business Center at City Hall or call 312-74-GO-BIZ. Also, business licenses can be applied for or renewed online at chicagobusinessdirect.org. If you are part of the BACP Entrepreneur Certificate Program, you can get credit for joining this webinar by sending an email to bacpoutreach@cityofchicago.org. If you want to learn about the program, please visit chicago.gov/businesseducation. Also, this webinar is being recorded and will be available at youtube.com/ChicagoBACP. I will post the mentioned information in the chat box. We encourage attendees to ask questions. Please use the chat box to send your questions. There will be a Q&A session at the end of the presentation. Please note that the views, information, and opinions expressed during this webinar are solely those of the presenter and do not necessarily represent the official policy or position of the Department of Business Affairs and Consumer Protection or the City of Chicago. Today's webinar will be Fund Your Startup into a Real Business, presented by SCORE Chicago. Turning it over to Toya from SCORE.
Hello, everyone. I'm Toya Hemingway. I am Chapter Chair for SCORE Chicago, and thank you for joining us today. Since 1964, SCORE has been the nation's largest network of volunteer expert business mentors and is dedicated to helping small businesses get off the ground, to grow, and to achieve their goals. SCORE provides free and confidential business mentoring on an ongoing basis to provide continued advice and support, and offers free online workshops on topics ranging from startup strategies to marketing and to finance. If you're interested in being mentored, please visit score.org/Chicago and submit a mentoring request. Now, my favorite part, I get to introduce Jeff Nicholson. Jeff is one of SCORE Chicago's volunteers, and with over 33 years of commercial and investment banking experience, Jeff was responsible for client coverage activities of diversified companies in central US. He has had the opportunity to observe and work with managers and owners across a wide range of industries, from large public multinationals to small privately held companies. During 17 of those years, he was also a successful adjunct instructor at both the undergraduate and graduate levels in both management and in finance. So please welcome, and thank you, Jeff, for doing this. Here's Jeff Nicholson.
Hey, good afternoon. Thank you very much, Toya.
You're welcome.
I'm going to be your guide today for financing your startup, and I very much appreciate everyone listening in. You know, when I was first asked to put this together, I thought, well, you know, all you need to do is sketch out your great idea on a napkin and people are going to throw money at you. Well, that's not really right, is it? This is more like it. Money is like gasoline during a road trip. You don't want to run out of gas. This was a quote by Tim O'Reilly, who was the founder of O'Reilly Media. It was the first internet web portal that was created in 1993, believe it or not. Our goal today is to learn a lot more about funding startups. And most people who claim to know, in my judgment, really don't know diddly about it. We're going to cover a lot of material. We're going to go a mile wide and an inch deep. So strap yourself in. Let's step back and think about the big picture here first. Look at these stages during the life cycle of a typical startup business. There's roughly 9 in the cycle. And this webinar is only going to deal with those 5 that are highlighted with the red halo. Most of the stuff you can read, most of the stuff you can find on the internet, And most of the webinars that you can go to are all about the stages that are not highlighted. So that's why this is put together. So let's dig in. Inc. magazine went to its 500 founders, and those are the 500 fastest growing privately held companies in America, and asked them to think back to their first year in business and identify the biggest mistake or challenge that they faced. And here's the result of that survey. Obviously, number one, by a large percentage, 45%, it was shortage of capital. And number two was a distant number two at 16%. So shortage of capital. Now, I know, you're looking at it and saying, wait a minute, that survey was taken 10 years ago. Is it still relevant today? Well, here's the result of some diligent work done just a couple of years ago. Now, CBI Insights is a private analytics platform, and it provides market intelligence about private companies and investor activities. It's a big data type company. So Startup Magazine worked with the data from CBI Insights that they accumulated on 350 startup failures, and they analyzed the information, and the results are displayed here. Notice that the two biggest reasons for startup failures are all about funding. Startups either ran out of money or couldn't find financing when it was needed. Well, the SBA says that the average cost of starting a new business is roughly $35,000. Now, if you're a storefront business, it might require 2 or 3 times that amount. But most businesses will be able to launch successfully with well under $100,000. And a sound business plan includes specific financial projections, including total startup costs. Now, estimating startup costs is as much about sales forecasting as it is about expense projections. And investors and lenders will want to know specifically where their funds are going to be used in your business. So where do you begin? You begin with yourself. No one's going to invest in your business if you're not willing to invest in your business. So we call that bootstrapping. After that, though, you have to get out a pad of paper and begin to list other sources that you might be able to tap. And a key objective of this workshop is to help you formulate that list of possibilities. And what form will the funding take? Big question. Will it be donation-based? Will it use loans? And will any of the funding come from sources that require an ownership stake in your business? And as you're pulling together your thoughts on these sources, you also need to cultivate a funding strategy. And by strategy, I mean determining A, the mix of resources, plural, I'll come back to that again, that you plan to use or try to tap. B, the specific milestones in your journey that determine how much and when the funding's needed. And C, how do you plan to approach each source? And each source might be approached differently. Now, returning to that survey, another question they asked was, how much money did you use to start your business in that first year? And if you look, those answers aren't far off from what the SBA said. Only 18% replied $50,000 or more. And well over half said less than 10 grand to start. And continuing with that, they said, well, where did you get the money? And notice 71% of those founders said personal savings. That's bootstrapping. Now, 21%, the second biggest category, was family and friends, and we'll talk about that. And if you add both the personal and home equity loans together, that represents 25. And bear in mind that that's where the founders are putting their personal assets at risk, versus getting debt to the business. And then there's angel funding. But notice on this list, there are no banks. And we'll come back to that again. So with that as background, how do you get started here? Well, I would start by trying to get answers to these two questions. How much money is needed and how will it be used? I always like to start with startup costs and asking, well, what are they? Most people make the mistake of thinking startup costs only accumulate until the business is launched, but that's not true. Take a look at this graph. On the far left side, that's where the business is launched day one. But afterwards, your business will still need to operate until you reach break even. And that's where the yellow arrow is. And until you break even, you need to cover or fund any operating losses until your dream becomes profitable and you start to finance yourself. And to complete that exercise correctly, you have to be able to forecast sales revenue. It's not just about costs. So what are startup costs? It's the cash outlays until break even is reached. And that includes capital expenditures. So if you want to buy a copying machine, for example, or a truck. Operating losses until you break even. You have to fund the losses. And then something that the banking world calls net working capital. Now, net working capital isn't anything that you see on your income statement, but it's illustrated on your balance sheet and certainly on your cash flow statement. So let me give you an example. Assume for the moment that you're actually a manufacturer, so you make things. So you need to buy raw materials to make a finished good. So you contact ABC company and you put in an order for raw materials, and ABC says, hey, you're a startup. I'm going to have to get your check first before I ship because I don't trust you. So you send a check, and by the time the company receives the check and the check clears, it might be a week or two, and then they assemble your order and then they ship it to you, and that might take another week or two, and you have a production process in which you make the finished goods out of that, and that might take another week or two. And when you sell them, if you sell them to an experienced company, they're not going to necessarily pay you day one, but they may pay you net 30 days. Now, if they pay charge card, you get it a lot quicker, but if they're paying by check, maybe net 30. So the money went out the door day one, but you may not get the check cleared or the proceeds from your sale for 2 or 3 months. So in that period of time, somebody has to finance the cost of the inventory and the receivables until they're collected. And that's net working capital. And that can be an important component of your business going forward in terms of what's necessary to be funded. So you'll be developing a detailed financial set of projections in kind of a two-part process. One is those one-time startup costs, and the second is the monthly operating expenses until you break even. And that could be, who knows, anywhere from 6 months to a year or more. And if your household is dependent upon the startup business, then you also have to consider adding in the personal living expenses as all part of your funding approach. So again, you've got to put together your profile until you break even and can finance yourself, and that's an important component of startup costs. So here's some guides to think about. Number one, plan for the unexpected. Have a contingency in your budget. You know, if you're building a commercial property, trying to get a loan from a bank to construct it, you've got experienced architects, you've got experienced engineers and contractors of all sorts. But a bank is not going to give you any financing until you have a contingency component in your budget for the unexpected. And that could be as little as 8%, as much as 12. But it's really planning for the unexpected that is part of that budgeting process, and you should do the same thing. Don't skimp on necessities. For example, well, maybe I don't need insurance. And you can always find ways to economize later. But what's really important is to get a reality check or two, and that's where SCORE mentors can really become effective for you. You put together your financial projections along with the assumptions that go behind the numbers, and you share it with people and ask for their reaction. The number one thing, however, that I can give you is that if you don't have enough cash to start your business right, wait until you do. Now, everybody write this down. www.5minuteclasses.com. When you go to this resource, you'll find a YouTube video called How to Calculate Startup Costs. It's really good video, and it's only 5 minutes. But it also suggests some worksheets that you could follow that can be also an important part of pulling together at least the cost side of what you'll need to go forward in your funding exercise. And again, just as a reminder, make sure that budget of personal considerations is part of it if it's supposed to be. Now, where can you go to get help in assembling all this financial information? Well, score.org. You can download what I believe is the best Excel spreadsheet for compiling financial projections, and it's free. So you just go to score.org, and in the search box, enter financial projections template, and boom, you will get the template that you can download to your computer, an Excel spreadsheet. It's an Excel workbook. And it has input sheets where you enter all of your information about cost of goods sold and sales and personnel expenses and all the details. And it also provides you some suggestions on some of the numbers that you might be able to use. And once you complete that workbook, the spreadsheet generates income statements for the first year on a monthly basis, on a yearly basis thereafter. It generates balance sheets, cash flow statements, and even has a tab to show you what break-even unit volume is for the company you're projecting. It also has ratio analysis, which might be helpful when you're talking to potential funding resources. But on that website, you will also be able to download a 40-page user's guide. And that gives you all the details and walks you through all the components that need to fold together in this workbook to generate the financial statements you'll need. And there's also a sample workbook that you can download that has all the financial information in it for, I think it's Anne's nursery. So I think she even has her personal statement on there. But you have all the assumptions and the income statements, balance sheet, cash flow, break even, all that is in Anne's nursery, and you can download that. Now, I really believe that there isn't a better Excel worksheet on the internet today, and it's free from SCORE. Now, we're not going to take the time to go through that here. We could spend a whole day kind of going through it. But you really need to go to the website and download this in the user's guide and begin to get familiar with the financial projection workbook that will be very integral to your business plan. Now, let's just switch gears for a minute. The likelihood that your startup will get financed by a bank is slim to none. In over 30 years of banking, I financed only one startup. It was 4 guys trying to build a business, and they needed $1 million. And the only way I got this approved was I took as collateral the stock portfolio of one of the founders' fathers that was valued at $1.5 million at the time. I also made the father sign stock powers over to the bank so that if at any moment I was uncomfortable with the situation, I could immediately sell the stock and pay down or pay off the loan. That's the only loan I made to a startup in my career, the only one that got approved. So let me try to help you understand, how does a bank think? Let's start by thinking about being an investor in a public company. So put your investor hat on. So you want to buy stock in a public company. Now, you know, when you do this, you could lose everything, right? If the company goes bankrupt. But you're willing to take that risk because you want to participate in the upside of the company. You'd like to know that you're buying into the next Google or Amazon, right? So that's why you're willing to take the risk. So now put your banking hat on. When a bank lends you money, it could also lose everything if it goes bankrupt. But the bank does not have the opportunity to participate in the upside of the company's future. Its upside is effectively limited by the interest rate that they're charging. And because it can't participate in the upside, a bank wants to be assured that they can be repaid in two ways. They want to have two legitimate sources of repayment. And the first one is always cash flow. So a bank will take your diligently prepared projections with all your assumption information, and then they will do their own version of it. They will consult with others in the industry. They will talk with, they will look at information from others of their customers that are in the same space, and then they will make adjustments to the numbers that you're expecting because they want to make a profile of what might be on a downside situation. And if at that point the company doesn't generate enough cash flow to pay the loan back, they'll decline. But if it does, if they're convinced that even in a downside situation there's enough cash flow to pay back the loan, they want a second way out, and that's usually the collateral that they take as security for the loan. And they take a look at what it costs and what they can get in a liquidation, because they don't want to stand around for a long time. And in a liquidation mode, if they can then be confident they could get paid back, then they will make the loan. The problem, though, is that if you're a startup, you don't have a history of performance to demonstrate the reliability of cash flow, nor do you have assets. You're looking for a loan to get the assets. So that's why banks don't lend to startups. Where can you go? Well, this starts our list. There's two columns here. One is debt, which normally you have to pay back, but it doesn't indicate that anybody gets any ownership of the company. And on the left side is equity, where you get capital, and from that, you typically give up a percentage of company ownership. Now, each of you should be thinking of multiple sources. I've said this before. Now, there's that asterisk there, which is about the SBA, Small Business Association. Now, the SBA really doesn't lend money. It guarantees loans that are made by other financial institutions and primarily banks. So if you think back to our net working capital example, what a bank will do if they're looking at the collateral to see if there's a good enough second way out, they're going to take a look at inventory and what can I get for the raw materials? Can I sell them back to the supplier, sell them to a competitor? For the finished goods, where can I sell those to the customers and at what cost? Because they're going to know that the company is going down because the bank is now representing the company trying to sell these goods. So they're going to have to offer some sort of discount in order to get that done. And with real estate or equipment, they're going to sell that on the open market in kind of an auction setting. And so if they look at all those components and say, gee, I'm only going to get 50 cents on the dollar with this existing enterprise. If I have to liquidate the collateral, they're not going to make the loan. But that's where the SBA can come in, because the SBA will come in and say, for this situation, we will guarantee up to 75% of the loan. Now the bank sits there and says, well, no, wait a minute. If I have to liquidate, I can get 50 cents on the dollar. But I can then go to the SBA and get 75 cents on the dollar. So for every dollar, I've got collateral or value worth $1.25. That's not a bad loan. I'll make that. So that's what the SBA does in assisting companies getting financing from banks and other institutions. Now, don't go crazy. This is a busy slide, I know. You're going to see it a number of different times. But I put this slide together for a group of companies in Chicago back during the Great Recession, because they did not feel they were getting access to conventional bank financing. So this was put together to show many sources of capital other than banks. And what we're going to focus on are those clouds that are highlighted in grayish blue. Those are the ones that have potential applicability to startups. The other clouds are typically applicable to companies that have been in business for some period of time. So they've successfully launched and they've got a track record of operating performance for typically a year or two. So for example, alternative lending in the lower right, those platforms that are listed only consider lending to companies that have stable and consistent sales for at least a 6 to 6 month period. And typically to get consistent sales for that amount of time, you got to be in business for a year or two. Well, obviously, if you're a startup, that doesn't apply to you. So for startups, let's start at the top of the page with micro lenders. Micro lenders are primarily intermediaries between sources of funds directed towards disadvantaged areas and actual needs of those areas. And that's why most of these micro lenders are not for profit and they operate very locally. The Community Reinvestment Act, or CRA, requires banks to lend to disadvantaged areas, and they keep track of all this information. So banks contribute to micro lenders and even participate directly in extending loans with those lenders in order for them to get CRA credit with the federal government. Now, these micro lenders are typically certified by the U.S. Treasury Department, and they're called Community Development Financial Institutions, or CDFIs. And there are 950 of them in the United States. Now, some programs also get support from the Small Business Administration through the SBA microloan program. And that's where the SBA guarantees up to 85% of the loans that are extended. And there are 32 of those lenders in Illinois today. So the key here is that your business needs to qualify because of low income or disadvantaged area. And so it's typically, so microloans are typically friendly to minorities and to women. And unlike banks, they are much more friendly to startups as well. Now my experience is that much of the lending is directed towards real estate and real estate development. But it's also available to startup companies for working capital purposes and to purchase equipment. Now, some of the loans are secured with collateral, and that's especially the real estate loans. And some will require co-signers. But in many cases, these microlender loans are unsecured. And typically they're for $50,000 or less. And as you can see, the rates vary widely depending on the circumstance, anywhere from 4 to 36%. But before the pandemic, the SBA microloan program nationwide, they averaged just a little under $15,000 per loan at a rate of 7.5%. Now, on that busy slide, which you'll see again and again, I listed Axion, Chicago Neighborhood Initiatives Microfinance Group, and CFA USA as probably the three biggest players in Chicago. But if you want to learn more about this channel, you should go to the CDFI Coalition, cdfi.org. And that's the trade group that represents microlending institutions throughout the US. And you could also go to the Opportunity Finance Network, which is a group of CDFIs that have banded together to work in a cohort. Okay, so that kind of wraps up the micro lenders. Now let's jump to family and friends. Now, believe it or not, family and friends invests between $50 and $75 billion annually in startups in the US. And that's 2 to 3 times the money invested annually by angel investors or venture capitalists in startups. So as a participant in this webinar, you are going to receive a copy of SCORE Chicago's Family and Friends Funding Guide. It's a 5-page write-up that yours truly put together, but it will give you a lot of insights on how to approach family and friends. And don't forget that in that survey with Inc. founders, 21% of them used family and friends as part of their first year financing. So it's very important part of reaching capital. And probably the trickiest part of family and friends financing is that, come on, you really don't want to lose money that your family and friends have invested in you, right? So you're walking this emotional tightrope by mixing business and family and friends. So my advice, first of all, only approach people who can afford to lose it. I believe this is the most heavily weighted criterion. You know, as a frame of reference, pension funds and other institutional investors typically allow their owners only 5% or less to be invested in risky assets. And let's face it, a startup is a risky asset. So your family and friends should be kept to similar guidelines and should be asked to invest only a small portion of their total net worth. So if Uncle Fred has $100,000 in net worth, you should only be asking for $5,000 or less from Fred for your business. That's the way to think about it. But you also want to focus on folks that are sophisticated and well-connected people, because they're going to ask you the tough questions that will ultimately benefit your management and your company in the long term. Better yet, aim at individuals that you can find that have experience in running their own business. Those are really great family and friend partners to get. And if you can find someone that has invested already in a startup or an early stage business, that's even better yet. But you want to avoid taking what I call dumb money. You want your seed investors, these initial investors, working for you to help maybe with the next round of potential financing, if it's necessary. So you don't want to press for money from someone who's uncertain, because they're going to be the first to complain if things get a little rocky. So you want to avoid investors with the potential to cause drama and stress. Frankly, you're going to have enough of that already. So here's my guide about the right approach. Build a relationship first. First, ask your targets for a reaction to your startup business concept. You'll be better positioned to ask for money later. But you really need to be prepared. You need to have a decent business plan that includes two important things. One is the validation from the market for your product or service, and secondly, the financial projections. And milestones could be used for triggering events. So as you're talking with family and friends about, how much money you need, it really, by following a milestone approach, it gives you a chance to have a series of smaller funding requests and then communication in between. And we'll come back to the milestones in a minute. Most of the capital that you raise from family and friends is going to take the form of debt, of loans. But you're going to have to decide whether debt or equity makes the most sense. And that family and friends handout guide that you'll get will go into detail on how to distinguish between those two. But you need to put the cards on the table. Even though you're confident in your success, you have to be honest about the risks that you face. You don't want to make promises you can't keep just to get someone to open their checkbook. Now, if you've ever looked at a public company and you read their 10K, which is their annual report, it has a whole section in there that's called risk factors. And company management and the investment bankers identify all the major risks that the company faces, and then they detail how they plan to steer around or through those risks and mitigate the problems. And you need to basically take that same approach. You need to be clear about the risks that you face. You want to be sure that you demonstrate your passion for the business, your due diligence in validating the reasonableness of your product in the marketplace, and you want to be respectful. Beyond anything else, don't be negative or arrogant, because that just turns people off. But you also need to manage expectations. And so it's the best practice is to send a regular update, whether that's by text or email or by snail mail, to all of your backers, and give them a clear indication of what's going on. You want to be honest about what's going well and what could be going better. And you may want or need to come back to these people for more money. So you need to keep them as part of a stakeholder group, and that communication thing is important. Remember, no lender or investor likes surprises. So endeavor to alert each supporter of any suspicions that you have to changes in expectations. That's really important. Now let's talk a little bit about milestones. Now this is a list that you could use for potential funding milestones, but it also can be used for the milestones in your business plan. It's almost a table of contents. So, I mean, proof of concept, where you have reliable evidence that your business or service is technically feasible. I like key partnerships as a key milestone. So, for example, let's assume that you need to build a website. So when you get a website designer and you sign a contract with them, that's where you can go back to your family and friends and say, all right, I've got a designer for my website. They're going to charge me $300. I really could use the money to get this contract finalized. Or it could be that you hired a marketing team that's going to integrate your social media platforms for communication to prospects. And that's going to cost you some money. So that's another key partnership. Obviously, key hires, once you develop a prototype, and that's a demonstration that you actually know how to make or produce what you're doing, then that's another milestone. A minimum viable product, which people will use to go out in the marketplace and to test with actual prospective clients, have them touch the product and look at the features and at least a minimum basis, and get some feedback about how good and what kind of problems those things solve. So these are milestones that are important potential ways to break down the family and friends funding so that you can slice off pieces at a time and then communicate with them going forward. And I think it's a really good approach. Now let's jump to another. donation funding. Now, you know what donation funding is, right? It's a subset of crowdfunding. And crowdfunding is raising money through the collective efforts of individuals and institutions that's coordinated through an internet platform, right? Well, any money that's raised through donation funding doesn't have to be paid back. It's a gift. And donation funding is critical because it's helped more than 1 million startups since it began in the year 2000. So 1 million companies, 1 million startups have gone to donation fundings, and these are obviously the biggest players that are out there today. Now, this is an area where your business plan, your conventional business plan is probably not going to be of a lot of use. You know, these platforms attract donors that are interested in, they're interested in projects, they're interested in causes, not necessarily interested in businesses specifically. So you have to change your thought process to align with these platform populations. And you've got to have a story that connects. Let me give you a great example. There was a woman here in Chicago that wanted to start a business in transporting children from couples who both work to and from school every day. And so she said, it's such a hassle to have working parents have to worry about getting their children to school. So she was going to set up this business to transport students back and forth. But when she went to get insurance for her vehicle, the insurance company said they treat her as a limousine and therefore she needs to contribute $10,000 up front to get insurance. She didn't have the money. But she went to donation funding and the story really connected. It was, I'm trying to help working couples in the city of Chicago, and the big bad insurance companies are charging me through the nose, thinking that I'm a limousine service. And so I need to raise $10,000 to get my insurance and kick this business off and she got the money. So each of the platforms does have their own unique approach. Some really like offering rewards. So that could be pre-ordering, getting a discount on the first run. Maybe it's just nothing more than getting a t-shirt as recognition or getting your name published on a donor list. But it may be a service that is given that is unrelated to the product. That's another reward. You have to evaluate each platform's assistance to see whether or not that connects well with you and what works best with your business. But you shouldn't be looking at this as a one-time event. You should treat donors or givers as stakeholders that may assist you again in the future. You know, the platforms provide you with the donor lists, the dollars that are given, and other vehicles to gather information about their contact information. And they provide you with updates, help you to take surveys of the givers. So going back to the donor population can be very successful. Peak Design, which is a creative marketer of outdoor gear, they've gone back 5 times. And the 5th time, they raised $4.9 million. So the approach is about a cause, a project, a product, really focused on something that might get somebody's attention. But beyond anything else, you need to have your own outreach program independent of what the platform's doing. You need to communicate with your friends, with family, with potential suppliers, and any other interested parties. You need to draw them to the platform. If you just rely upon the platform itself, you might be disappointed, and I can't stress that enough. Now, donation platform programs are either fixed or flexible. You know, if you're fixed, if you don't raise the money that you targeted, you don't get anything. The flexible ones, you keep whatever you raise, even if it's below the bogey, but the fees can double. So the fixed program, you pay 4 or 5% on the money that you raise. The flexible ones can be 8%. And in addition, there's financial transactions that are occurring here, right? I mean, people are contributing money. It's going to your bank account. You're going to be using it. And so there's payment processing fees, and that can add another 1.5 to 3% again, and you're going to have to be paying for those. It's interesting that the all or nothing campaigns get fully funded at twice the rate of the flexible ones. And if you think about it, that makes some sense. If you're trying to raise $20,000, and if you get 19.5, you get 0, you're going to work extra hard to get that $20,000 because it means so much. Now, the average campaigns raise between $25,000 and $30,000, and they usually last about 9 weeks of elapsed time. The average pledge, believe it or not, is under $100. And overall, fully funded programs have 300 backers. So it's very, very granular. The biggest raise ever was over $20 million on Kickstarter in 2015. Pebble Technologies was promoting a new smartwatch. Their target for marketing was $500,000, and they raised $20 million. Can you believe that? 2 years later, the company was purchased by Fitbit. So it was a very successful operation. And the last thing I'll say is that campaigns with videos earn 100% more than campaigns without. Now that's my story about donation. Let's jump to angels. Now, if you don't know what an angel is, if you've seen Shark Tank, you've seen angel investors. Angels are usually wealthy and successful business people who are interested in investing their own money in startups and early stage businesses. And sometimes they work alone as individuals, and sometimes they're part of a group. And in this case, if you look, I've listed the top 7 angel groups in Chicago. Now, there is a difference between an individual angel and an angel group. Angel groups are much more formal. They often anticipate being part of the next unicorn or IPO. So, and by the way, seed capital, I've said it before, it's on this slide, that often refers to the first of multiple rounds of funding for a business. So angel investors are typically more interested in ownership than they are in debt capital. So even if they issue debt to you, it's usually convertible into equity. They want to have an ownership position. But unlike other investors, they're not interested in running the business day to day. They leave that to you. They're going to be satisfied with a minority position. And most of them will want to provide some advisory support, mentoring assistance to you as a founder. And maybe 1 out of 3 actually wants you to set up a board in which they want to have a position on the board to help with decision making. The angel groups have a shorter time horizon than other potential investors. They're kind of looking in the 2 to 5 year range. That's really typical. And they want, during that period, to have a full or partial exit where they will recoup some or all of their investment. And often, as you've seen on Shark Tank, the valuation of the business is really critical to success. Now, we could spend a whole workshop or webinar on the valuation process. Just know that it's really critical to understand valuations as you're beginning to recruit these investors that focus on ownership. Now, oftentimes angels and angels groups see themselves as filling the gap between family and friends and venture capital firms. In fact, I believe that an increasing number of angel groups are looking for funding evidence of family and friends before they'll even consider looking at your proposal. After all, if people that know you aren't willing to contribute money, why should they? Because they don't know you. So that's kind of a view of the angel groups a bit. Now, I believe there's a greater chance of landing an individual angel investor if your business plan is not targeting a near-term initial public offering. So if you're looking for patient capital to support your startup, you're looking for mentoring support, and your time horizon is 7 or 10 years or so, then individual angels are a much better match. But if your ambitions are much more aggressive, then this is the list of things that you need to have in place in order to attract the attention, let alone the capital, from an angel group. Your product or service is developed or it's near completion. You've got existing customers or confirmed orders from potential customers. You've sunk your own money in, and you've recruited family and friends funding. And you can clearly demonstrate with your financial projections that you can grow rapidly in the next 2 to 5 years. So your business plan has to really be in top shape. It's easier to find angel groups than it is individual angels. I mean, you got the list of the top 7 in Chicago on that slide. In any of these situations, to find either an angel group or an individual angel, it's great to be able to get an introduction from someone who knows them that can broker an introduction between the two. This is really critical for you to network. I mean, these guys are getting dozens of opportunities to look at, and what they want to do is get as many off their desks so they can focus on the ones that are good. And so you need to stick out somehow, and that's where networking can really be a help. And LinkedIn is really, really critical to use in order to try to find a way to network in. Now, the Angel Capital Association, the ACA, is a trade association that represents angel investors. It's a great resource, a great website to find studies, to find characteristics of angels, and a bunch of articles and white papers about that environment. So if this is a target group, the ACA is definitely a place you want to go to. Now, angel.co is a place that most people that are familiar with it, they go to post for a job in a startup, or a founder can recruit for their startup through Angel Co. But if you go to the web address listed, which has North America/investors, you'll be able to find a long list of individual angel investors in North America. And that's the largest list I've ever seen. And then you can go to the largest funding platform, which is the Angel Investment Network. And they've got 250,000 investors across 80 countries. And it's a angel funding platform. They give you all the same tools that you might find in a donation platform for, structuring your request and all that. But it's another source to think about going to. Now, at this point, we've covered most of those gray clouds that I talked about initially. These are the sources we didn't cover. Now, equipment finance can be available to startups. So if you're looking to buy some equipment and the manufacturer has a leasing arm, then that might be a great source for you to finance the purchase of equipment. I mean, the manufacturer knows the useful life and the depreciation of the equipment better than anyone. And so they'd be able to structure a lease, which is really 100% financing. to structure a lease that satisfies their needs. So if they have to take over it, they can still sell it and make back what they need to. So equipment finance is possible if you're buying equipment. Factoring is another thing that's possible for a startup. If you've got an order for a potential product that is from a big creditworthy company, you might be able to get financing from a factor, and I've listed a couple here. So if it's like a Target and that you've got a potential order or an order, you can go to them and find out what kind of proceeds you might be able to get after delivery of your product so that you don't have to wait 30 days or more to get the receivable paid. Now, the other two things on this slide, which are also interesting, are Lendio and Fundera.com. Now, these are platforms in which you register and you talk about your situation, and they put you in contact with multiple sources of capital, like the ones on that big slide. But again, these are typically for businesses that are in existence for a time, that they've got a track record. And that's why it's not as applicable to startup businesses. The other thing I wanted to point out is the Illinois Investment Network. It too is a web-based portal that matches investors with entrepreneurs. Now they've got two different kinds of, they have multiple levels of service. One is a non-commission, which you don't have to pay for. And those services in which you do have to pay, I think the smallest amount is $149, but it's for like a listing, if you call it that, for like 180 days, where you're out there in their network, being connected with potential investors of different kinds that are all looking. And there's a number of states that are all connected with this Illinois Investment Network. But again, this is for businesses that have some multiple years of track record. Let's talk briefly about alternative lending. The lines have been blurring a lot between crowd lending and these alternative lenders. This is a list of the big ones, and you've seen a lot of them advertised on deck, Cabbage, others. Really, they're looking for a minimum of 4 to 6 months of actual in-business experience, and they're focusing on monthly revenues. And the reason they're doing that is they take money out of your account every day or every week in order to pay back the loan. So they want to be assured that every day or every week you have a certain amount of sales that are being accumulated in your account. And usually that kind of consistency of sales revenues will require a minimum of 12 to 18 months of operating history. And they will tell you that they don't charge an interest rate. They charge you a factor rate. So they may loan you $100,000 and say the factor rate is 1.2. So you're going to pay back 1.2 times the $100,000. But I've done the calculation to find out what is the APR for that. And depending on the situation, it ranges between 30 and 50%. Now you should know, again, this is for established businesses, but millennials are really taking advantage of this. If they have a project or if they have a potential sale that they have to finance the inventory for, they may go here and say, gee, I might be able to get this done with Target, for example, and instead of my 30% gross margin, I'll get 15%. But it's a lot of dollars, and so I can cover a lot of operating expenses, and I can show that I've got business with Target. And so as long as I'm making more money than the interest rate is charging me, and they can make that calculation, they can figure that maybe this project, because these loans typically last only 6 months. So if you can do a project or get something done in 6 months' time and make some money on it after you've charged the APR, it's a product that a lot of millennials are using. Now, one last piece here is equity funding on the internet. You may have seen advertising for Start Engine. Kevin O'Leary, Mr. Wonderful from Shark Tank, is always advertising. You should know that there's 50 of these kinds of companies in America right now. But in order to even be a participant, to register to try to get money from these platforms, you need 2 full years of audited financial statements that you have to file with the company like Start Engine before you can even consider getting funding from a portal. So, you know, this stuff is important to think about after your launch. After you've got some operating history, I wanted to give you a sense of some of the things that are out there that go beyond your break-even level. Remember, what we were going to cover in detail was really those 5 areas in the life cycle. And if you take a look at this big slide, there's a lot of pieces here, right? We've talked about, you know, going to get multiple sources, different approaches for each, and it sometimes can be very confusing and hard to piece it all together. Well, as a participant in this webinar, you're also going to get a picture of something called how startup funding works. And this picture should help bring all the pieces together when it comes to complex funding stages from like a beginning to an end. And I think you'll find it very helpful. Now, I've taken this picture and I've broken it into 2 pieces on 2 slides because they're, you know, it's big. But let me just run through this quickly to give you a sense of how these pieces can fit together with a hypothetical situation. So you start on the far left, your idea stage, you're the founder, and you have 100% ownership of the company. And as you move forward, you start to think that you need some more expertise. So you take on a partner. And so maybe it's a 50-50 split between you and the other partner, and you're building your business, you're trying to get going forward. And now as you're looking at your projections, you understand you really need some money. So you need cash and you're willing to go to Uncle Fred. And you know that because of his net worth, you can probably get up to $15,000 from Uncle Fred. So you get the $15,000 and you give him 5%. You see it in mauve there, 5% to Uncle Fred for his $15,000 contribution. Now forget about the option pool for employees. That just kind of convolutes things, but that's very typical because that's how you attract new employees to a fast-growing business. You give them potential options in the business, but we're not going to deal with that. So at this point, you've got Uncle Fred that's giving you some money, and maybe 6 months down the road, you start to realize that you're running out of Uncle Fred's money. So now you need to approach some angels. The angels investors, that's your seed round. And you're going to approach 1 or more angel investors because you need real cash. And at this point, you think you need $200,000. Look at that on the far lower left. So you go to the angel groups and they're going to make a valuation of your business. And they're going to determine in their minds that your business is worth $1 million. So they're willing to give you, they're willing to give you $200,000 for that valuation. And for that, your ownership percentage will decline. And it'll decline from where it was to maybe 31%. And the angel will get maybe 16.7 according to this. Again, the option pool just confuses things. But that's the way it works. So you get your shares reduced, the uncle gets reduced, the angel comes in, provides some equity capital. You've got a business now that's worth $1 million and you got $200,000 in cash. Well, your business is streaming and you're hiring people, you're growing, But in order to scale up the business, you really need money now. And so you need $2 million according to your projections. And you're going to go to one or more venture capital firms to do what they call a Series A funding raise. You're going to get another valuation, and they're going to come up with their own valuation. In this hypothetical, they say it's worth $2 million. So they're going to contribute it's worth $4 million. So they're going to contribute $2 million in cash to you that you can use. And what winds up happening is that the venture capital firm gets a third of the business. Your shares go down with your co-founder down to 19. Uncle Fred's cut in half, and the angel group has got 10%. And finally, you're persuaded to go public. And so you deal with the investment bankers who are going to take you public, and they're going to raise $235 million for a business that they say is worth $2.6 billion. So they're going to go public, and they're going to sell enough shares in the public market that the public will own 8%. Now, the venture capital firm is going to be the second biggest owner at 30%, and the two founders are down to 17%. And the angel group is below 10. But all of these pieces together, you kind of take this big headline, which is you started out with 100% of nothing, and that's a lot less than 17% of a big public company. So I hope this gives you a sense of what is beyond the startup, give you something to look forward to, depending on your ambitions. And at this point, I just want to say that our objective today was to learn more about how to fund your startup business. I told you it was going to be a mile wide and an inch deep, and I hope we accomplished that today. I want to thank you for signing in, and if nothing else, I hope I made you think. Now I'm willing to entertain questions for however long it takes.
Great. Thanks, Jeff. Great information as always. Let's start looking at the questions. Someone clarifying the web address, www.5minute.
5 minutes classes. Hold on. Let me be 100% sure. I think it's plural. No, 5 minute is singular, 5 minute classes. Sorry.
Perfect. Lots of great jobs. Thanks for the information. A few people asking about a copy of this webinar. The webinar is being recorded and will be posted on BACP's YouTube page. I put it in the chat, but I will do that again. It's www.youtube.com/Chicago BACP. Geez, Jeff, lots of thank yous. This has really helped me strategizing my next steps. Thank you for providing this webinar. Thank you. Great presentation. Love the webinar. Do you have any information related to fiscal sponsors?
To fiscal sponsors?
Yes.
I don't really. I mean, these are commonly, I think you're referring to like private equity groups as fiscal sponsors. If I'm incorrect, maybe correct me, but I lump those together, quite frankly, with venture capital firms. So private equity firms, venture capital firms are equity investors looking generally to own a major portion of the business for their infusion.
Great. A few questions on how do they get in contact with you and SCORE?
Well, to get in contact with SCORE, just go to score.chicago.org, and you can sign up to get a mentor. And that first mentoring session is to kind of get acquainted and to find out what your real needs are. And if there's something that's very specific, then the mentor may operate to find you a resource that directly connects with your specific industry or issue. Otherwise, they provide great general support.
And then just if they have any clarifying questions for you, you have an email address or something you'd like to provide?
They can go to jeffrey.nicholson@scorevolunteer.org.
Perfect. Can you also give the website for the SCORE expense report?
It's score.org.
Okay.
I mean, for the financial projection workbook?
Yeah, I think that's what they're,
Yeah, score.org.
lots of
That's
thank
the-
yous. Thank you. How do we get the guide? I believe,
Well, I'm going to send the picture I mentioned, a PDF of the slides, and
Great.
the funding, family and friends funding guide to BACP, and they can forward it on.
Perfect. Great information, very knowledgeable. Can we put the website for the mentor in the chat? Toya, maybe you could help out and put the SCORE information. That would be great. If recently bankrupt, what are the chances for starting a business?
That just makes it harder. You know, it's bankruptcy does have conditions with it. A lot of people are familiar with bankruptcy territory. So whether you're a micro lender let's face it, failure is not something that has the connotation it used to. So entrepreneurs that do not have success are not frowned on like they used to be. So, you know, it's important to acknowledge that something went wrong. Maybe you know exactly what it was that torpedoed the business. And if you can present that to someone, they're familiar with people that have started things, and some of the most successful entrepreneurs in the world have businesses that failed before they were successful.
Great. Next question. When it comes to a nonprofit organizations, I find the donation funding sites and angel donors are great resources. Do you have any other resources or suggestions for funding?
No, to me, those are the two best. Some people talk about getting grants. I think that's a tangled web, but I do believe that donation funding and angels are the two best for nonprofits.
Great, thank you. Toya from SCORE is actually saying score.org/Chicago. So thank you for that. I had a few people asking for that. You didn't mention grants. Do you have any info relating to acquiring grants for startups?
I do not. I've looked into this over the years and have found that it's a very tangled environment, and the opportunities are far fewer than you would think. So I've just not covered it for that reason.
Any resources for commercial real estate for startup outside the SBA?
Well, I mentioned it earlier, micro lenders are a good source. I think the majority of the loan volume that they actually fund is for real estate and real estate development.
Just looking through. This seems to be more focused on providing a product. How does this apply toward providing a service?
Well, the big difference between the two is from the funder's standpoint. When you have a product, you have tangible collateral and tangible assets that generate income. With a service, you know, it's intellectual property. You know, the assets walk out the door every day. So the big issue is reliability of revenue stream. And so that's really the critical issue for a service business. So they'll substitute the reliability with for some will substitute for collateral, but you'll probably service companies with other than receivables don't have many assets. So the receivables will become assets to the potential lender or funder. But in order to get those assets, you've got to have contracts signed. So that's really the focus for a service business.
Okay, great. What is your greatest advice for a first-time business owner who is preparing to take the very first step?
To me, the most important thing for an entrepreneur is to get real, and I underline real objective validation from the marketplace for their product or service. That is number one. You might think it's great, but frankly, your opinion doesn't matter. It's what the marketplace thinks. And if you can get validation, meaningful validation, that's your first hurdle.
Great. Another SCORE question. At SCORE, are there mentors that have experience in specific industries like construction?
Well, SCORE has a lot of individuals here in Chicago that have specific fundamentals. You can read about them on the website. Also, SCORE nationally has access to mentors that you can do email mentoring. So you may find somebody that is perfect in Michigan that is willing to provide email mentoring to you on a specific industry. So there's lots of resources. It's incumbent upon you to work diligently with whomever you first mentor with to find the right match.
Great, thank you. There is a question. What is the email address for the city program that gives you credit for the webinars? It is bacpoutreach@cityofchicago.org. That's bacpoutreach@cityofchicago.org. And I will put that in the chat as well. Another question. What is a good way to measure your products and services earning potential in the market?
Well, I guess you need to first, there's another webinar that would help with that, by the way, but you're really first trying to identify what are the characteristics of your target market. So that's where you start. And if you don't aim with a rifle and you aim with a shotgun, you're never going to get an answer to that question. So you have to be very specific. You have to be very targeted. You have to identify as many characteristics as possible of your target market. And then you can find out what that size is of that market. Once you find the size, then you can kind of say, well, if I get a 0.5% market share or 1% market share, that's what the potential is for my business. But you have to start with that target market. And people don't want to be as focused as they should because they think they're missing something. And it's just the opposite. If you're not targeted, you won't get an answer. You're just going to be flailing in the breeze.
Lots of thank yous, thank you, thank yous. It seems extremely difficult to start a business if you or your family do not come from money. Are there any success stories of only using micro lenders and donations?
Yeah, I mean, you're going to have to contribute something. I mean, and sometimes it's time, sometimes it's equipment. But frankly, just being able to demonstrate that you found some resources, just kind of get it going. When you go in hat in hand and you've not put anything into it yourself, it's really hard for somebody to get excited about that. I'm just being honest with you. That's where you may have to find a partner. I mean, most major successful companies are not founded by one person. And so it may behoove you to take a look at bringing someone else in that has some other resources, financial or managerial, that might be helpful to the business.
Okay, great. Thank you. We'll give everyone another minute to put their questions in the chat. The entrepreneurial certificate email was put in the chat as well, along with the YouTube page. It looks like that was the last question. Thank you everyone for attending. Jeff, thank you as always for presenting such great information. Everyone is saying thank you, thank you. Toya, thank you for representing SCORE, and I hope everyone has a nice night. Thank you again.
And good luck to everybody.